All righty. I'm going to be doing the town hall tonight. I want to thank those of you that are here with us live today. And I know that most people are watching it now on the recording. We do appreciate that very much and would be very happy to have you join us on the live segment. We do have a question and answer period after that we don't put into the recordings for privacy issues. But you're more than welcome to do so. I am pulling the load myself today. Steve is off on vacation. He and Lori are out cruising around Greece somewhere. And Deanna had some personal issues she needed to take care of today. So I got elected to do the presentation for the day. Quite a few things that I do actually want to talk about. My topic for today is actually, I have two of them. One is a uh, software technology assistance program for estate planning that we signed up for a year or two ago. And it allows us to assist our clientele in doing their estate planning. We're not attorneys, so we can't draw up wills and powers of attorney and trust and things of that nature. But what we did was we contracted with an online firm that is national, that has independent attorneys in every state that can do specific state reviews and make sure that the documentation and everything is correct for that particular state. But essentially, it allows us to help input the data and ask the right questions and present that to the law firm. They then prep the documents and send that back to us. So we're not actually practicing law or anything of that nature, but we are assisting you in having the helping the attorneys get everything set up the way you want. The advantage is that by using this technology and us doing the prep work and helping you set this up, it comes out to be far less expensive than it might be to go directly to the attorney yourself. There are cases where you're better off doing that. But if we're talking about just ordinary wills, trust, powers of attorney, things of that nature, you can probably save a whole lot of money by looking at what we might have to offer through the company is called Encore Estates. And I'm going to share a screen here with you. Basically, what I want to do is just kind of show some blogs that have come out on this particular company to give you a general idea of where they are, who they are, and what this is all about. Encore Estate Plans wins again. The KITS Advisor Tech study showing from a technology standpoint, this is a very, very good program to help advisors be of help to their clientele in establishing the documentation necessary for estate planning. The other one is Encore Estate Plans named one of the top startups, the Start Bubble. They started a few years ago, but this article was just written in May of 23. And it is a very powerful program. It's extremely well written. We've done a whole lot of trust and wills and powers of attorney and things of that nature for our clients, and it has gone very, very well and quickly. Another one I like is who's actually running the thing. Yeah, Encore Estates Plans, they hired the Riskalyzer co-founder, Matt Pistone, as a chief technology officer. Riskalyze is it's now called Nitrogen. It's an extremely well-known risk analysis and planning software used by financial advisors all over the country. So it's a very, very high-end tech situation, and their chief technology officer is actually working with Encore now. So, and that explains one of the reasons why the software is so darn easy to use, quite honestly. Advisors rank Encore with the highest customer satisfaction. I would have to be in that category. They are available if I have a question, if a client has a question. I can't answer legal questions, but I can get on the phone and talk to one of their attorneys and have direct advice or information given for to answer those questions or to point them in the right direction to get the right question answered. There is a lot of material. One of the coolest things about the software is that when you're filling in the information like name, address, phone number, and how do you feel about that? What do you want? Who's going to be your financial custodian if you become incapacitated? And there's a little thing with an eye on it. You click on that and it gives you a dissertation on what that means. There is a glossary of terms. There is a how do you do this? What do you do about that type of information built into the software. So it helps you make your decisions as you go through filling out the information as to how you want things run. Then we get it reviewed by the attorneys. Once everything and everybody's agreed on it, then they print the materials and give it back to us. Then it needs to be witnessed and signed. They take care of transferring a deed to at least one property as part of the package. And the cost on this is just I won't quote that over the recording here, but I think you'll be pretty favorably impressed as to what it might cost you to go get the same thing done. New state-specific attorney review. That's a really nice feature. That is not some attorney in Florida telling you how things work in Missouri, or a Missouri lawyer telling you how since you moved to Texas. I believe there's only one state in the country they don't operate in, and that's North Carolina, if I remember correctly. But just about everywhere else, we can do it in any state and have state-specific attorneys answering those questions. So if you have not done a will or a trust, and you want to look at the possibility of doing one or both of those things, then please give us a call, contact us. Let me give you a link to a file that will let you fill out the information, or at least we can answer your questions about what the cost for the different plans might be. But we provide these at a pretty nominal cost for our clientele. We are not interested in doing this for the general public. It is specifically for our planning clients, but we're more than happy to help to get these things set up. Now, what if you already have a will or a trust, and it's you did it 10, 15 years ago, and it needs to be updated? The laws have changed, your life has changed, your family has changed, your situation has changed. You may want to make adjustments to those legal documents. It's exactly the same price to have that trust or will restated. Essentially, if it's a trust, they keep the same name and the same start date, so you don't have to repaper all of your accounts or things of that nature, but it restates the trust according to the laws and requirements that are in effect today, and adjusts for any changes that you might have that have occurred in who's supposed to get what, when, where, or why. Plus, you might have to make adjustments on what you wanted because of new laws like the Secure Act and how IRAs or Roths might be treated. And again, you can have a will and power of attorneys, which are very, very important, or you can have a trust, a will and powers of attorney. If you already are happy with your will and power and your trust, but you don't have the powers of attorney set up for each other or for yourself, then you can just get that done. So it's very specific about how we can build out the legal document packages to make sure you're taken care of in that particular area. The biggest advantage of having your financial advisor work with you on this is that we know where the money is, we know what strategy it's in, we know what the nomenclature is. Is it an IRA, a Roth, a non-qualified? How do those things transfer at death through these different modes using a will, a trust, or powers of attorney, or in cases just the operations of law with a proper beneficiary listing. So this, in conjunction with the making sure your beneficiaries are set up, can handle a lot of your estate planning and legacy issues. But like I say, if you wish to have a will or trust restated, please feel free to check with us. We'll be happy to take that document and give it to the attorneys and let them update it for you. And again, pretty nominal prices for our planning class. So I'm going to stop with that particular one right now, because there was another subject that I really wanted to get into, and that is, what is a retirement analysis? Now, for those of you that are already clients, you've kind of been through this process on more than one occasion. Okay, the second thing I want to talk about a little bit today is what we are really looking at when we talk about retirement analysis. So I'm going to share another screen with you. Okay, I'm going to go through just kind of a quick checklist about what we do. Some of you that have been with us for a while have been through some version of this, but this might give you a little more background information on just how in-depth some of these analyses are. One of the first things we do on a retirement analysis is income analysis. We want to look at your income projections to show your cash flows that are needed to sustain your retirement needs and where they may be coming from. We're going to look at Social Security projections. Now, why does it say cause and effect? Well, if you're a married couple, when one of you passes away, part of that Social Security will disappear. So we're not just looking at the analysis of while you two are together, but what happens after the fact when one survives the other. It's very, very important. Then we want to look at the COLA projections. Do we build in a true to life cost of living adjustments that are with Social Security? We absolutely do build that into our planning. Pension optimization. That can be, do I get a lump sum or do I take the pension, which is better? That has changed dramatically just in the last few years. For the longest time, a lump sum beat taking the pension quite often. But today, because of higher interest rates, the companies have to put less money in a lump sum to guarantee the pension. So now the pensions might be better. Do we take a survivor benefit or do we not? That's the cause and effect thing, the survivorship thing. Then we look at asset analysis. Individual investment. We actually look at how you're currently invested and look at what those investments would have done over the last 10 or 15 years using Morningstar quantitative reports that can actually look at your current holdings and analyze how they would have performed. So we're not really guessing a whole lot in that. We're looking at true to life performance. We look at the rate of return needed before and during retirement. It might be different. Weighted portfolio returns on the risk balance metric, distribution order. What order you spend your assets in or what combination can affect your taxation, which then can affect how much you pay taxes on Social Security and or Medicare Part B, and also the just normal income taxes over time and stretching those assets out. Risk versus low risk assets. What combination should we have? How much of our monies do we want to make sure is going to be there regardless of market performance? And how much of it are we willing to risk for market for maybe potentially higher growth rates? So there's a huge balancing act going on there, and it has to be constantly adjusted. Then the risk analysis on the portfolio, basically to find out what your temperature is. Like if we were talking about cookies, do you eat the cookie dough or do you like them burnt really hard or somewhere in the middle? Where's your temperature setting for your ability to accept risk and be comfortable with it? And then making sure your assets are structured appropriately. Should we have income annuities or SPIAs? Do they make any sense for you? Should we have one for growth or for income? That's part of the protected values that we might have from market volatility. So there's a lot of things going on there that we have to analyze. Okay, expenses. This is a really difficult subject because it takes people a while after they retire to really get comfortable with how much real spending is going on, because it's confusing when you make the transition. I make this much money every year, so that's what I'm going to need in retirement. Well, is it really? Because when you take your gross income, part of that you may be putting into a 401k. Part of it you may be paying for other types of insurances. Part of it you may be putting into other types of tax deferred vehicles. When you are retired, you're not going to be doing that anymore normally, because you're only going to be taking out enough money to meet your lifestyle needs. So your actual taxable amount probably wouldn't change. Let's create an example. Say I had $100,000 income and 15 of it is going to 401ks or things of that nature. And so I have the 85,000 and then I pay taxes on the 85,000. Well, when I'm retired, I still need the 85,000 and pay the taxes on it. My tax bracket probably didn't change all that much because I wasn't paying on the part I was saving in the 401k anyway. So I kept it pretty much the same tax bracket, same income level, but I only pulled out X number of dollars, which might not be 100, it might be 85,000, pay the taxes, and that gives me my income. I kind of went through that really quickly, but it's part of the analysis when you're looking at expenses. A lot of people find out they spend more in retirement because every day is Saturday, and when you go out and do things, sometimes it can be expensive. We want to get those traveling years in that we weren't able to do when we were working and raising kids and things of that nature. So there's just a whole lot of stuff going on there. Then we also have to look at how expenses might change if we become single again, because we have to remember we might lose part of our Social Security, we might lose part of the pensions, and we might be in a higher tax bracket, because single people hit higher tax brackets at lower income levels. And that has to be part of the analysis that goes into it. That leads us into the next one, which is the tax analysis. We know what the current federal and state tax rates are now, and we know that they may very well change. They're scheduled to change unless something is done differently in Congress. In 2026, we're going back to the same rates we had in 2017, and that will be a tax increase of several percentage points for most people. Not everybody, but for a very large percentage of us, it will be. And itemized really doesn't work that much, too much. I think less than 1% of the people in this country are able to do itemization for their tax planning. It's generally going to be standard deductions, which have risen considerably over the last 2 or 3 years. So that has to be taken into effect. But then what if they come along and raise taxes? One of the things that we can do in a tax analysis is project a small or larger increases just to see how it would affect your retirement portfolio and plans to be able to continue. Excuse me. If we're not retired yet, we still have to live, and we may still or may be working. We may, and excuse me, for pre-retirement, we're looking at the analysis of, okay, we still have the larger incomes, we're working, and how much are we saving? How are we saving it? How you save your money. If you have assets you're putting away for retirement, if it's 4, 5, 8, 10 years before retirement, you really need to sit down and talk to retirement specialists that are geared toward how do I create income streams after I retire? Because that gives you a window of time to readjust how you're putting your assets together, because it can make a huge difference when you get to retirement, what form your assets are in. And if you're doing your planning 3, 4, 5, 8 years before retirement, it gives you more time to make those adjustments. And then you have to go back to our tax analysis. If I'm making these adjustments between IRA, 401k, 401k Roth, Roth conversions, insurance products, if I'm doing this to have a better taxable retirement or tax exempt retirement, then I need to understand how to get from point A to point B for the least cost. Because if we're doing tax planning and paying taxes early to avoid bigger taxes in the future, we have to look at the brackets that would put us in. So if that sounds complicated, it is. It's a complicated process of cash flows, how they're coming in, how they're going out, looking into the future, analyzing potentially tax rates in the future, looking whether we're single or not. All of that stuff has to go into part of the analysis. So it can get real complicated real fast. That's what we do for a living, and we're more than happy to do that for people that are interested in working with us. Retirement analysis, take all the data and display in a monthly or annual summary, do budget analysis, retirement funds, income analysis, graph displays, constant reviews, even after you retire. It's not a fire and forget situation. We are constantly adjusting what we're doing, how we're doing, what risk level we're at, what tax structure we're in, or to keep up with the current tax law changes and also just life in general, because your situation can change considerably from one point to another. Market comparison analysis, are we just putting everything in the S&P 500 and whatever happens, or are we trying to manage that money? It's a huge difference between when you're in the accumulation mode and building your assets versus when you're retired. A quick example of that is if I'm 45 or 50 or whatever, and I am putting money into a 401k or any type of investment portfolio over a period of time. Sometimes the shares are higher and sometimes they're lower. If I'm putting in a consistent amount, sometimes I'm paying a higher price per share, sometimes lower. I have fewer or more shares. Over time, this is called dollar cost averaging. It tends to lower the overall average cost of your shares, but it also means that you're buying shares when the stocks are down, and when they come back up, your greater number of shares has a bigger upside. Now, let's reverse the situation. I just retired you. You're no longer buying new shares. You're not taking your paychecks and buying new shares. You might trade shares internally in your existing portfolio, but what you have is what you have in general, and you're supposed to now live off of it. So if I have these shares and I'm pulling an income stream from those shares and they go down in value, and I still need my income because I don't want to have less retirement, I want to enjoy the same retirement ongoing, well, then I might have to sell more shares to raise the capital to meet my needs. So now we call that reverse dollar cost averaging. You could actually make the cost of funding your retirement more expensive that way. So it generally behooves you to, when you're in that retirement zone and ready to move, to rearrange your money for income structure versus growth, and make sure that the income is going to be there regardless of the market, or at least have it less susceptible to market fluctuations to provide your income. It's a very, very big deal. When it gets into life insurance analysis, that's a lot of people that are close to retirement think, I don't need insurance anymore because the houses might be paid for. I don't have kids to raise, and I got money in the bank. That's generally not what we use life insurance for. Specifically, when it comes to retirement planning, there are a lot of other things that we can do with life insurance that are unique and very special. There's an entire section of the IRS code called 7702, which is dedicated to all the wonderful things you can do with life insurance. And if you don't know what those things are, we would be more than happy to explain it to you, but it is phenomenal. One of the things it can do is double as a coverage to help pay chronic illness or for long-term care situations. You can use the death benefit while you're alive for newer life insurance policies. A lot of them have a chronic illness rider or a long-term care rider that allows you to pay, take that death benefit out while you're alive and use it to cover your expenses for care. Why would that be important? Well, it's not a use it or lose it type situation. If you don't need long-term care and never have to pay those bills, then that life insurance goes to your heirs on a tax-free basis under the current law. So it's a pretty doggone good deal. We actually do that type of planning for our clients at no additional charge. It is part of our practice for any and all people who decide that they are interested in becoming clients of ours. That's the type of analysis that we do for no additional charge whatsoever. And there's quite a few other things that we do. We don't really charge a fee for helping you with the estate planning. That's just the cost of getting it done is about it. But there's not a lot of load built into those either. So if either one of these things are of interest to you, whether or not that is getting your retirement analysis done, and you're looking for someone that specializes in retirement planning and estate planning and things of that nature, then we might be a good choice for you. We would appreciate the heck out of you giving us a call. Go to our website. There's a link on our website. You can click a button and set up a 15-minute appointment on your own to just have a conversation with us and see if it's worth your time to come and visit with us for a more in-depth conversation. If you are a client already and you haven't looked at your wills or trust and you want those reviewed, then you might want to give us a call and talk about that. That's kind of one of the things that I help take care of. Be more than happy to explain it in more detail to you and see if it's something you want to get into. Okay. I want to, again, for Steve and Deanna and all the crew here, I want to thank you guys for joining us on the town halls. I want to remind you of an upcoming event. I think the next one is November the 30th. It's a really big deal. We have a very large event that's happening. We're holding at the DoubleTree right down the road from us here in Chesterfield. And we have the pavilion rented out down there, and we're going to have hors d'oeuvres and adult beverages. And we are having Brad Jenkins, who is the CEO and Chief Financial Officer for Market Guard, as one of our primary guests. We're also having Bob Thomas who is the CEO of Impact Partnership Wealth, which is the new RIA that we have joined recently. So it's going to be a big event. We'll have several other people there. All of our crew will be in. I think Megan's coming in from New York. Chris is coming up from Tennessee. So we will have the whole crew here. And it should be a really fun event and also extremely informative. And it'll give you a chance to meet the upper echelon of the people that we have joined recently. So be looking at the newsletter for that. And I am going to, at this point, stop the recording.